Hello and welcome to Macro Matters, the economics and politics podcast from Aberdeen Standard Investments. My name is Paul Diggle, and along with my co-host Stephanie Kelly, we are exploring the themes and questions that matter for the global macroeconomic outlook. And on this episode, we're taking a deep dive into inflation. What has the impact of the coronavirus crisis been on inflation? What is the outlook? Why are investors talking about inflation regime change and fiscal dominance? And are these realistic prospects? And it's worth mentioning that the inflation outlook really is a live and lively discussion among investors at the moment. I'm regularly asked, why is inflation so low? But also, could this crisis ultimately see inflation rise much higher? And the performance of financial markets in turn would, of course, depend a lot on the answers to these questions. The secular bull market in both equities and bonds would look quite different in a world of much higher inflation. So to set the scene, let's hear from Fed Chair Jerome Powell and ECB President Christine Lagarde talking at their latest press conferences about the current inflation environment.
The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices picked up over the summer, in part reflecting a rise in durable goods prices. However, for those sectors that have been most affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective.
Headline inflation is being dampened by low energy prices and muted underlying price pressures in the context of weak demand and significant slack in labor and products markets.
So that was Jay Powell and Christine Lagarde. And joining me for this episode are senior economists in the Aberdeen Standard Investments Research Institute, Sree Kochugovindan and Luke Bartholomew. Sree and Luke both have done a lot of work on the inflation outlook, historic inflation regimes. So I'm really looking forward to this conversation with them. Sree, why don't we start by talking about recent trends in inflation? What has the coronavirus crisis done to headline inflation, energy prices, food prices?
Well, so far, the impact of inflation, of the pandemic, has been broadly disinflationary, and that's been across a number of countries. If we look at Japan, Germany, and some of the peripheral European countries, we're actually seeing outright deflation there, negative headline inflation rates. So this is likely to be very temporary, though. A lot of these drivers are being impacted by the pandemic. First of all, we had the collapse in energy prices. That was earlier this year, and that's weighing on headline inflation across a number of countries. And that's going to persist, that impact will persist until April, and it's likely to drop out after that. And there are also some technical distortions, for example, the change in timing of seasonal sales relative to the previous year, and we can see that in some of the clothing indices. And then there are some prices that have been hit quite hard by the lockdowns and the restrictions. So, for example, in travel and tourism, across cinemas and theatres, those prices have been impacted as well. And another factor would be policies. So, for example, the German VAT cut. In Japan, we had the Go To campaign, which was the subsidizing domestic travel. All of these policies are likely to impact inflation temporarily while they're in place.
So the impact has been broadly downwards then on a lot of prices across the economy.
There are some pockets of price pressures as well. So we can see increased demand for secondhand car sales, increased prices for haircuts and dental care. These are sectors that have been impacted by social distancing. So they've experienced an increase in cost, and we're seeing the increase in prices for users there as well. So it's a real mixed picture, but a lot of these, so the picture is distorted by a lot of temporary drivers in either direction. But broadly, we've seen disinflation so far.
So Luke, there's also this question of simply the measurement of inflation. During periods of the lockdown, the people from the statistical agencies who go to shops, go to supermarkets and physically write down or record the prices of goods just weren't able to do that. So for a while, at least, it was very hard to even measure price pressures to start with.
Yeah, I think that's exactly right, Paul. I think there are maybe two ways you can think about how the crisis made measurement very difficult or increased mismeasurement issues. The first is the way in which you described there, that it's just very difficult to compute, or perhaps even impossible to calculate the index, as we can't go out and get the prices. Perhaps there's a sense in which some of the prices are now infinite or indeterminate. You literally just can't go and consume a pint in a pub, so what's the price of it? But then there's, a slightly deeper way of thinking about it, and that's that there is this sort of platonic sense, this true idea of inflation that economists have in mind, that they're trying to measure with the CPI or other inflation indices. And there's a sense in which the gap between those two has probably increased during this crisis as well. So there's sort of the true sense in which economists mean inflation is what they call a cost of living framework. And the idea there is how much money it costs to get you to like the same level of utility or welfare. And so to truly measure that, you need to capture things like the way in which people's consumption can substitute between one good or another. You might be consuming very different things, but you're getting the same welfare from it. And also like the quality of the good that you're consuming. Maybe it's a TV, but it's a much better TV. There's some higher quality to it, even if it's at the same price. So we have this sort of substitution effect and hedonic psychological quality of the good. And typically we think that measured inflation tends to overstate those factors. We're not very good at capturing quality improvements, and we're not very good at capturing substitution effects over a period of time. So most of the time we think that recorded inflation overstates quote unquote true inflation, and that's mismeasurement there. But during the crisis, we probably had the opposite of that phenomena, in the sense that the quality of a number of goods, the hedonic quality of them, the welfare they give you has deteriorated. Perhaps, university lectures delivered over Zoom are that much worse than being there in present, despite the fact that, you still have to pay the tuition fee. So the price of that has gone up. Similarly, I think there's been quite significant substitution effects in the basket. People are consuming a lot less travel than they used to, but a lot more food. And there's been upward pressure on food prices and downward pressure perhaps on transport prices, or they haven't moved. But so people are consuming much more of a good where the price has gone up, and that's not being captured in the index. So mismeasurement because we can't go and record the thing, and mismeasurement because it's doing something, what we're measuring is fundamentally different to the true idea of inflation we're trying to capture.
Yeah, these are deep and sort of complicated questions about index composition and the true meaning of inflation, and the way in which our measures of inflation are just a proxy for some of these deeper concepts. But so that matters in and of itself. But another important way in which inflation matters is that it guides what central banks do, one way or the other, tighten or loosen policy. And I suppose questions of true inflation mean different from measured inflation. The latter is just low. Does that change the policy outlook? Do these questions change what we expect central banks to do or markets to do?
Well, I guess part of the reason we want to stabilize inflation at target is not just because, we want stable inflation at target, but also because it's meant to indicate something about the broader state of the economy, that we're at full employment and all resources are being utilized. If we weren't, then it'd be very difficult to have inflation at target. So even if there are weird things going on in terms of measuring inflation at the moment and what's true and what's not, I think one thing we can be very confident about is that there is a large output gap, that labor and other resources are not being utilized to the extent to which they should be. And one way in which the central bank can deal with that is keeping policy easy. So I think the outlook on the policy side remains pretty clear, just because of what's happening on the real side of the economy, the production, the employment side, and that's the side of the economy that clearly requires ongoing support and stimulus.
So, having laid out recent inflation developments and issues with the measurement of inflation itself, in the second half of the episode, we want to talk about the future inflation outlook, and in particular, the issue of inflation regime change. could the long-term legacy of the coronavirus crisis actually be to push inflation much higher? And to set the scene, let's hear from Claudio Borio, who is the head of the Bank for International Settlements, often described as the central banker's central bank. And Borio is a proponent of this idea that the inflation regime is going to be much higher, and inflation will persistently run higher into the long term as a result of the crisis.
Strength. So imagine a world in which we have much higher private and above all public sector debt. And we know that debt was steadily increasing in relation to GDP before the pandemic. And that, of course, the pandemic was giving it a big push. Imagine a world in which globalization is in full retreat. We have already seen some signs of that, as firms have onshored part of their operations in order to reduce their vulnerability to global conditions. Imagine a world in which the role of the state in the economy is much greater. Again, the pandemic is working in that direction, and so is the progressive erosion of the policy room for maneuver.
So that was the case for higher inflation in a nutshell. But Luke, why don't we stick with you for now and talk about inflation regimes over time? There seems to be this clear pattern of periods where inflation is persistently high. The 1970s is the sort of decade that people point to most often, and then periods where inflation is persistently low, and the 2010s is one such example. So why do we get these inflation regimes in the historic data?
Sure. I think you can think of a regime as perhaps sort of a constellation of at least sort of the configuration of maybe three factors, one of which is inflation expectations and the stability of those inflation expectations. The second is what we call the nominal anchor, what ultimately locks down price stability, or what in perhaps a deeper sense gives money its value in some way. And then the third is the relationship of the economy with regards to its potential. These are sort of like the fundamentals, I think, that pin down inflation regimes over the medium to long run. And I think observing, as you say, like the 1970s or indeed the 2000s, or perhaps the Japan experience in the 1990s, one of the things which we can learn and thinking about those three factors is that what it requires to get to a regime of much higher inflation is well, the economy must be producing above capacity. And that could be because demand's very strong, or could be because supply growth is very weak. And that was the case in the 1970s. Even with quite weak demand growth, you could get excess demand because capacity being impaired by things like the oil price shock, productivity growth slowing down. Second of all, the nominal anchor, the thing that gave inflation its value, had been sort of shaken up by the US coming off the Bretton Woods system, and then this sort of shook up inflation expectations, which then got pushed high. People couldn't ground inflation expectations on anything quote unquote real, and then there wasn't policy there to deliver any sort of stability to inflation either. Central banks weren't following what we call the Taylor principle, which is this idea that ultimately you can't keep on allowing real interest rates to carry on falling. Otherwise, the economy just gets ever more overheated and inflation ever higher. The Fed in the US were operating under a slightly flawed framework for thinking about the economy, and therefore weren't setting policy in this way. So you need inflation expectations to be unanchored in some way. You need policy not to be set in such a way as to sort of deliver stability in the economy, and you need a situation of excess demand to get you from a low inflation regime to a high inflation regime.
I suppose those three factors, they apply in reverse in the 2010s, don't they? They also help explain why you go through a period of such low inflation, because you had excess supply, insufficient demand in the wake of the financial crisis. You had an overly strong nominal price anchor i.e. inflation expectations were low and anchored low. Everyone expected inflation to be low. So in part, that's why it was. And then arguably you had central banks who were too credible. They were too good at following the Taylor principle, such that policy actually ran persistently too tight. So you can flip that framework on its head and also characterize the lowflation regime, I think, through that lens as well. So Sree, why don't we talk about why some investors, some people in the market are arguing that the legacy of the coronavirus crisis will be much higher inflation? What are the drivers that they point to that they think are going to push up inflation as a result of this experience?
I think the oft quoted reasons would be that the pandemic has led to some changes in the secular drivers that have been at play over the last 20 years or so. So these long run supply side drivers could include things like globalization and technological progress. Demographics are often quoted as well. And we can see how that has been quite a key driver in terms of bringing down the trend in inflation, but also the trend in wages. It had quite a big impact on global labor markets. So we can see that since the 90s, the integration of China and the former Soviet Union countries into the global economy had quite a big impact in terms of substitutability of labor in developed markets and emerging markets. Also, in parallel with that, we had technological progress, which again led to substitutability with some skill levels. So wages trended lower over this time, and they actually became much more correlated globally. So that's one aspect that has driven inflation lower. But going forward, we can see that, the last few years, we've seen a slowdown in globalization. The US-China trade tensions, or trade tensions in a more broader sense, have led to a slower pace of global trade. We've seen COVID really bringing up concerns about the fragility of supply chains. And we've seen how a lot of countries are now thinking about, how do we address this? How do we secure supplies in healthcare, for example? And this can be done a number of ways, whether it's onshoring some of the production. That could be one way of doing it. It takes a very long time. It is a slow and costly process. But also this can be done through automation. And that's something that some governments are talking about. In Japan, they're talking about digitalization or investing in technology. But one side of that is automation within in order to protect supply chains. So these drivers are often discussed as a long run impact on inflation, which could shift to another regime. But I would also repeat what Luke said earlier. They would work within the context of those three drivers that he mentioned in terms of persistent excess demand, inflation expectations, central bank frameworks. These are all what really will help shift from one regime to another. And again, going back to the idea, the example of the 1970s, the overall supply backdrop was much weaker back then. So it's easier to move into that period of excess demand against a very negative range of other factors and trigger those inflationary pressures.
So it seems to me it's quite straightforward and easy to make the argument that globalization could go into reverse, or at least plausibly could slow down as a result of the coronavirus crisis, because as you say, firms may prize the resilience of supply chains over sourcing goods at the lowest possible cost. And in a sense, there could be an upward influence on inflation. But how did demographics change as a result of the crisis, or how do productivity trends plausibly change as a result of the crisis that might push inflation higher?
And you're right to point out demographics. That is often used as a reason as well. We're all aware that across many countries, we're going through a process of aging across many developed markets, but also in Japan, China as well. And this actually works through a number of different channels. The one reason that people often give is that of the workforce, the size of the workforce relative to the total population would be shrinking. And that could shift us back to a 1970s style, increase in wage bargaining, or, the 1970s were characterized by labor unions having more power. So this could lead to some wage pressures. But I think in isolation, that's a very narrow argument. We also need to think about other factors such as migration flows, the way aging will work through not just the wage channel, but through product prices in terms of how different demand in different sectors change. And also political economy can't be ignored either. It is the case that the older the population, the greater the dependence on fixed incomes. So this idea of reflating away debt could be quite difficult. There is some political economy side of the story there, where they would not be in favor of higher inflation. They could be more likely to vote for policies that would protect against that.
And what about this driver that I often hear put forward in the case for higher inflation, which is fiscal policy could potentially be much more active in the future? I mean, clearly it has been extremely active over the past year, and that may mean a few different things. It may mean that monetary policy aims become sort of subservient to fiscal aims. It may mean that the independence of the central bank is threatened, or the central bank is pressured to ensure government debt remains cheap and easily serviced, rather than the Taylor rule is followed, the Taylor principle is followed, and interest rates are set with a view to controlling inflation. Do we put much weight on that argument? That's essentially the fiscal dominance argument.
I think you're right, Paul. There is an argument that's often made in that the current policy mix can be seen as very stimulative and highly inflationary, but it's not yet fiscal dominance. That would be going back to the arguments that Luke made, that we would need to see a significant shift in the central bank framework in order to get to an inflationary scenario. And if anything, what we're hearing from different governments, I mean, in the UK, for example, they're already talking about the risks of excessive government debt. They're already talking about how we're going to scale back policies, and there is this move towards caution rather than a shift towards fiscal dominance in the tone that we're hearing at the moment in a number of countries.
Yeah, and I suppose the US would be an obvious example there as well. Had it been a Democrat clean sweep and a composition of government that could have pursued much more expansionary fiscal policies, perhaps that believed in modern monetary theory around the fringes as well, you could be heading maybe down a fiscal dominance route. But a divided Congress, much less in the way of fiscal stimulus, doesn't push you in that direction. So Luke, why don't we get into then what the view that we have as an economist team, which is that in the end, the crisis isn't going to lead to a much higher inflation regime. And if anything, the risks are probably skewed in the other direction, that you're just further embedding the disinflationary regime that has characterized the past decade or more. I mean, how do we go about making that argument, particularly in the context of these three drivers you were talking about, the balance of supply and demand, the strength of the price anchor and the central bank inflation target, and the central bank's ability and willingness to control inflation?
Sure, yeah. I mean, so the world that we think we're most likely to be going back to after the crisis passes is what we've described as back to the new normal. And let's remember what the new normal was. It was a world of much lower growth in the developed markets compared to before the financial crisis. It was a world of extremely low interest rates and often bumping up against the zero lower bound or the effective lower bound, and one of low inflation. And we think not only are we going back to that world, but to some extent that world on steroids, in the sense that inflation will probably be even lower, and there's going to be some permanent damage done to the level of GDP as well. The economy is just going to be permanently smaller than it otherwise would have been. And why so? Well, first of all, I think it's pretty clear that the crisis has opened up a large output gap. The demand is running well below capacity, at least at a global, as it were, level, or economy-wide level. Certainly, there will be pockets and areas of excess demand for particular goods and services, and you could definitely see some price pressure there, but we would be very clear to distinguish that from inflation. They're probably one-off price level increases, or indeed just market signals that resources need to be reallocated. That is not inflation. So
and that would be the point about haircuts or the cost of, hard to access dental treatment, or, there's been a spike in secondhand car prices over lockdown as people have moved away from public transport. It would be, well, perhaps those are isolated price pressures, but that's something different from generalized inflation.
Exactly right. In a market economy, relative prices are changing all the time. Those are signals about where resources need to go, the relative balance of supply and demand. And that's perfectly normal. And of course, the crisis has shocked different sectors differently, and therefore there will be different price responses. But inflation as a whole, that matters about resource constraints at the economy-wide level. And in that sense, I think it's pretty clear there's going to be spare capacity, underutilized labor, capital not being put to work. On top of that, inflation expectations are extremely low and indeed are falling. Now, there might be sort of a head fake for some people about seeing goods and services that they regularly interact with, pockets of price pressure being there. So you could see these surveys moving around a bit, but in terms of market-based inflation expectations, those are very, very low. So inflation expectations seem to be anchored in that regard. And third of all, for all this talk of policy radicalism and huge central bank balance sheets, from our perspective, most of what we've seen has, if anything, been characterized by a certain institutional conservatism. I mean, take, for example, the Fed's fated policy review, which they spent 18 months consulting various people, and ultimately what they came up with, this average inflation target, whilst a positive step, is, in the scheme of things, pretty weak beer. I think it is a long way from quote unquote true radicalism that might involve, fundamentally rethinking the tools that are used and the targets that guide policy making. So yes, a lot of spare capacity, inflation expectations very low, and no sense in which central banks are violating the Taylor principle or behaving in any sort of quote unquote radical way. Gives us the conviction in our base case that, the most likely implication of all of this is lower inflation.
It strikes me that a sort of additional important concern regarding the Taylor principle and the extent to which central banks can control an increase in inflation by raising interest rates is that there's just a lot of room for central banks to do that. The flip side of interest rates being at the floor is that there's a lot of space to increase them. It's the fact that they can't be decreased particularly further that is why you get asymmetric downside risk to inflation, but you can quite easily, as a central bank, it strikes me, raise the interest rate and contain a potential breakout in inflation.
Yeah, it's very easy to stamp on excess demand right now. It's much harder to stimulate it.
Brilliant. Well, Sree and Luke, thank you very much. I think that's a really clear run through of the inflation outlook, why our view is that we shouldn't fear the breakout of inflation. Thank you very much for listening to Macro Matters. We're going to be back with a number of episodes before Christmas. Really hope you can join us for them. If you're enjoying the show, please give us a like or a retweet or a share or a follow. We'd really appreciate it. But until next time, good luck out there.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.